Hi, I'm Antony Michels, and this is NeuGroup Insights. Today we're talking about a growth tech company in the SaaS sector and the evolving capital structure that it created with the help of MUFG. And joining me now is Lucia Greenblatt, who's a director in the technology banking department of MUFG. Hi, Lucia.
Thanks, Antony. Great to be here.
So what was the situation with the company that we're talking about that we're not naming in this case, but what was their situation when you got to them?
You know, every situation is a bit unique, and it's somewhat driven by the company's maturity stage in its life cycle. As a software company grows, it doesn't generate positive net income and even positive EBITDA at the outset, and therefore it's difficult to structure a financing solution that is underpinned by EBITDA. In that case, a solution that doesn't rely on leverage metric is probably more suitable for the capital structure. And for example, a convertible note doesn't rely on ratings or on any financial covenants. Therefore, it's likely a more suitable instrument and in the early stages of a company's growth. If a company considers a convert, they need to think about the instrument's cost over the life of the instrument, not just at the outset. And if you think about a SaaS company, which is high growth and commands a high multiple, it is likely good to consider what is the evolution of the stock price over the life of that instrument. Is it possible that multiple expansion could happen as growth becomes more profitable, even though it's likely a little bit more tapered? And those conversations are very important, and companies will feel pressure to act because certain markets are open at certain times. And what we see is when a peer comes to market and they successfully raise in a certain market, the board will ask, what is going on? Give us an update on the market. How can we tap that market at that point in time? And as a result, we see a number of peers successfully accessing that market at that point in time.
The problem with going for a convert without due diligence or considering enough is that down the line there could be a repercussion of dilution. Is that right?
Dilution is definitely one of the challenges that have to be considered at the outset. Many of the companies that issue converts also do that in conjunction with a share repurchase, or they overlay a hedge that significantly increases the premium that is commanded by that convert in a synthetic way. So the premium will end up being not up 40 or up 60, it can be up 100. And that hedge can be expensive, but it's worth considering it.
In the case of this company, why was it important for them to have the convertible financing in place? What did they need the money for?
Look, as the company accelerated its growth, it realized that growing through acquisitions was reasonable at that point in time of its life cycle. And in order to accelerate that, they had to raise funds. And because the company didn't have sufficient EBITDA to underpin a traditional financing package, the company decided that convert suited that credit profile at that point in time. And we see that pattern with early stage high growth SaaS companies where EBITDA is not in the quantum yet that could underpin a significant financing package.
Given where we are in this economic cycle with thoughts of inflation, thoughts of maybe higher interest rates, but an economy that's being given a lot of stimulus, is this going to change the landscape for growth companies and how their capital structures evolve?
It's a very dynamic market, Antony. It reverted fast to the pre-pandemic levels. As you know, the Fed was very proactive about enabling the economy to stay afloat throughout the pandemic. It's primarily driven by the company's ability to generate cash flow. And accelerating cash flow generation is the primary objective to underpin a more efficient structure or an investment grade like structure. However, an investment grade like structure comes in with a framework that is based on covenants, and high growth SaaS companies may need the flexibility to operate outside of those covenant packages. And the covenants are financial covenants, negative covenants, affirmative covenants. Financial covenants are the ones that will drive the availability of credit for the company, because that's primarily driven by leverage and coverage. And leverage is measured as debt to EBITDA, and coverage is measured as EBITDA to interest expense. And it's very important to understand how much flexibility you need, even if your credit profile is investment grade like. And if you feel that you will need to lever significantly in order to do acquisitions or for other material events, perhaps delaying that transition to investment grade makes sense. But that's a decision that is made individually in each case. And we usually see companies being very considerate about their model, about the pipeline, and about the operating risks.
What do you think the main takeaways are from the experience that we sort of tracked with this company whose capital structure evolved? What lessons do you think they learned, and what can you pass on to other companies?
Now, very interesting question, Anthony. I think the lessons are in the eye of the beholder, and everybody gets the blessing of the lesson and moves on. I think flexibility is very important, operational flexibility. And when you choose an instrument that suits well at a certain point in time, you need to have a long-term view, not just the point of view at the time of issuance, especially if there is a derivative involved. But going back to flexibility, flexibility has shown to be a dominant criterion in deciding the capital structure choices, especially throughout the pandemic. At the outset of the pandemic, when the markets were dislocated, it was very clear that companies that were flush with cash were the ones that had the most flexibility, because they didn't need to tap the market at that point in time. However, as the markets became more and more open, excess cash became a bit more of a liability and potentially even a little bit of a drag on the valuations. So it's all relative. The construct of what is optimal at certain points in time takes a lot of deliberations and understanding against the company's objectives, the company's model, the company's growth path, and obviously the industry in which the company operates.
Thank you, Lucia Greenblatt of MUFG. Thanks so much for joining us.
Thanks, Antony. Appreciate it.